Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
Hey, this is Clay, and it's a beautiful morning here in Minneapolis, Minnesota. It's about 72 degrees outside. We're about to kick off part 2 of this deep dive on programmable tokenized debt and debt markets with Nadav Hollander from the Dharma Protocol. Before we get started, however, I want to thank you and everyone else who's made what we're doing here at Nomics possible. About a year ago, we started all of this with nothing. Now we have paying customers, we're approaching being cash flow positive, we have sponsors, and this dream that my co-founder and I had about this time last year is becoming a reality. Thanks to everyone who's subscribed to our API or to this podcast on iTunes, who's sponsored a show, who's shared our content on Twitter, who's built apps with our data and linked back to us. Thanks to everyone who's left a review for this show on iTunes or subscribed on iTunes, or anyone else who's referred this podcast or nomics.com to a friend, or who's mentioned us on Reddit or Telegram or wherever you share this stuff. Thank you for helping us make this dream we had a year ago a reality. Like you, we're excited about the decentralization and tokenization of the world, and we're really thrilled that we get to do this full time. All right, I'm done being sappy. Let's get to the show. Welcome to part 2 of our deep dive on tokenized debt with Nadav Hollander from the Dharma Protocol. Part 1 of the series holds the record for the greatest number of downloads within 48 hours of publication. Like I said previously, this conversation isn't quite a full-fledged documentary, but it also isn't your average interview either, so I'm calling this a deep dive. In part 1 of this conversation, we discussed why debt, and particularly tokenized debt, is such a big deal. As a reminder, in the United States, the money supply is valued at $13.5 trillion. The stock market, on the other hand, is valued at $30 trillion, and the bond market is at $40 trillion. And the bond market doesn't even include household or other forms of debt. So it's safe to say that in the United States, debt markets are much larger than the stock market and at least 3 times larger than the money supply. So this conversation, the one that we're having right now, is a large and important discussion, and it deserves coverage. For more background and context around this discussion, please stop now and listen to part 1 of this series if you haven't already. As an overview, this deep dive is broken into 5 chapters. In the first chapter, we discussed the history and origins of debt up until around the year 2000. We also discussed the Web 2.0 peer-to-peer lending solutions that preceded Dharma, such as Prosper and Lending Club. In the second chapter, we discussed the history and development of crypto asset technology that has paved the way for programmable tokenized debt. In chapter 3, which we covered in part in the previous episode and finish up here, we discuss how the Dharma Protocol works and the first-class operators within the system. Chapter 4, which is the main focus of this episode, looks at the top use cases and investment opportunities for tokenized debt. In Chapter 5, we wrap everything up by discussing Dharma as a corporate entity, where they're located, how they make money, stuff like that. In the previous installment of this deep dive, we covered Chapters 1, 2, and part of Chapter 3. In the second installment, we wrap up Chapter 3 and complete Chapters 4 and 5. Let's get to it. Nadav, thanks for sticking around for part 2 of this conversation and going the distance with me. Let's get right into this and assume folks have listened to part 1. Okay, so I think a lot of our listeners understand crypto exchanges better than they understand debt markets. At least most people in this space do, but it definitely seems like crypto exchanges can be used analogously to help us understand debt markets. For example, on crypto exchanges, you have a seller and a buyer who post a bid and an ask respectively. This is analogous to a lender and a borrower in debt markets. Also, in debt markets, you have an order book of borrowers asking for loans, and these orders are filled by lenders. With Dharma relayers, there can also be transaction fees, which obviously go to the relayer, and then there's interest on the loan, which is also a factor. I hope this isn't offensive, and I mean this as a compliment truly, but it sounds a lot like the Dharma Protocol is basically 0x for debt markets.
That's not offensive. I often characterize Dharma like that, like as 0x for loans. Like it kind of is that, right? Like at the end of the day, because it's basically like what a loan is it's basically like the borrower selling a debt asset to someone, right? It's basically like, I'm going to sell you the rights to these future cash flows at the price that is the current principal of the loan. So it is basically a maker and taker arrangement. Just the crucial things that need to be layered on top of it is like, okay, well, how's the taker going to have any idea of how to price this thing in general? And so like there needs to be some sort of like underwriting mechanism or some sort of guarantees about the repayments to happen. And two, just like one thing that is not possible in 0x, which is inherently why we need like an entire new set of infrastructure to do this with Dharma, is that you can't like post orders for assets that like don't exist yet. In the case of Dharma, like that's basically like what it is, right? You're posting an order saying like, if you agree to this, I'm going to create a debt token and sell it to you for the price of the principal. That's essentially the missing layer there.
It sounds like maybe second class operators, or I don't know if operators are right, but like sort of things that exist, entities within the system are potentially identity systems and oracles. I guess in a lot of cases, those things are bundled, that if you have a trustworthy idea of the real world identity of someone, now you can start doing traditional credit scoring. It's hard to verify that someone owns a home or has a job without an oracle system. But how do you think about identities in oracles?
And that's kind of like the holy grail here, right? Like it's like I mentioned earlier that there's not really good reputation systems right now in the decentralized space. And something that I view as being like a crucial element to enable that is just like having a good identity standard. And there's been lots of people who have been working on it for a while now. And at least my opinion is that we haven't really seen like any sort of meaningful traction yet in that regard. But I think that it'll come eventually. And when it does, I mean, that's going to be hugely empowering, right? Because now all of a sudden you can actually have now that like a public key is at least associated with someone with some sort of like identity that is not reproducible, or not like, the technical term for this is a Sybil attack, right? Like you can't take it and just create like 7,000 copies of it. Once you have that, then you can actually build like an on-chain record of your creditworthiness. And so essentially you can imagine, I'll give you an example really quickly from the real world. So there's a company called Branch that was started by a guy named Matt Flannery, who originally started Kiva, which is the first micro-lending platform that was on the internet. And essentially Branch, the way that they do, what they do is they give out basically like microloans via mobile phones in the developing world. And, as far as I've understood, a lot of the ways in which they give out loans to borrowers who basically have like no credit history is that they'll basically start with like a really small amount, right? Like, so you can imagine I'm going to lend you like $20 and you're going to owe me $21 in a week. And then once you return that small amount of money, probably 30%, maybe like 40%, I don't know, some large percent of the people who got that initial amount of money just totally ran away with it and didn't pay back. But they're not going to get any other loans, right? The X number of people who actually did pay back the loan, and then now can take out a large loan. Now they can take out a $40 loan, and so on and so forth until they kind of like build their credit worthiness over time. And surprisingly, this model actually works, right? Like there's definitely a certain portion of people who exit scam the system and kind of like basically run off with some people's money. But by and large, the aggregate math of it works out that like if the interest rates are set at a sufficiently high rate, that this can end up being profitable for the lender. So essentially, what you can imagine is that if we had a good identity system on blockchains, which right now we don't necessarily, but imagine we did, then you could build that same sort of creditworthiness on chain in a decentralized manner. So you wouldn't even need like a quote unquote underwriter to sit there and judge the borrower's creditworthiness, because the borrower can just go up to a lender and basically say like, look, this is my public key. It's associated with my immutable identity. And if you look at all the loans that have been taken out by public keys associated with my identity, I have this stellar creditworthiness that has taken me like years to build up. And so I really think that it's crucial for us to like find a workable identity solution. I don't want to sound cynical about this. I have many friends who are in this industry who are working on this in various capacities, and I believe in them and I believe in their projects, but we haven't yet seen anybody like crack it successfully and really achieve meaningful traction.
How do you think about a potential skin in the game issue around the underwriters? If there isn't an identity attached to the underwriter, they could do a stellar job approving these loans or denying, and then all of a sudden approve just an incredibly large loan and then disappear. Can underwriters stake tokens or somehow put real world assets on the line?
So you're really getting at the core of the reason why we consider unsecured lending to be a very experimental feature set in Dharma right now. And that's basically that, like, you really need to put a lot of trust in the underwriter in the system right now, because not only can they do things like what you just kind of described, but they can mess with the whole system in a lot of more nefarious ways. Like, a really bad example of this would be, an underwriter going and basically like generating a bunch of different public keys and lending themselves a bunch of money and underwriting those loans, and basically like building up like a false sense that they're a really good underwriter because, they've underwritten all of these like loans in the past. But when you look at the loans themselves, it's actually just like all the underwriter's public keys, and it's just him lending money to himself. And then all of a sudden, they go out and take out the giant loan and say they have perfect creditworthiness, and then they run away. And this is a core reason why we say, like, this is very much like a delegation of trust. Like, you're pretty much just like, if you're going to be like investing in a loan that is underwritten by some party, like, you better know who that party is, and they better be like a public known figure. Like, it better be, the example that I give is that, like, you probably wouldn't want to invest in a loan that was just like some random public key that may have a good reputation, but it's a different decision calculus if that like is Coinbase's public key or something like that, right? So that's kind of one example that I get. Just to take a step back, we have been thinking a lot about like, how can we make underwriters, or rather the underwriting scheme at large, more secure against these issues of them basically not having like a formalized reputation or identity. And we actually just recently wrote a blog post about this that I'd encourage people to read if they want to go deeper into this. But basically, there's a couple of approaches that we're thinking of. One is actually kind of adopting a structure that is very similar to the way that the internet's certificate infrastructure works, and essentially like delegating trust between different underwriters. And to kind of dive a little deeper into that, I'll give you kind of a specific example. Imagine like, we zoom like 20 years into the future or something like that. And there are like two very well-known underwriters in America that are like have an excellent social reputation. Like, they're kind of like the equivalents of like an Experian and a TransUnion or something like that, right? They're just like these like household names that are super regulated that, if they were to try to pull off some sort of like massive exit scam or something like that, it would just be like a massive public issue, right? And like these companies would have to face some sort of legal repercussion. And that's great, but that's not really like the world that we're trying to like aspire to, right? Like, we want to create a world in which there's infinity different underwriters and that this scales in a much more decentralized way. So what you can imagine instead is that you adopt a system that's kind of like similar to the internet infrastructure of certificates, where like the way that certificates work on the internet right now is that there are these like root certificate authorities that are often for-profit companies that are centralized entities, but like are a very limited set of like entities, right? It's like some like set of root level certificate authorities that all the browsers decide, like, we're just going to trust these root authorities. And then, the way that you make that more scalable and make it so that, you can have something as like widely deployed as the internet and not everybody has to go through these root authorities, is that these root authorities now can like vouch for other authorities. So they go out and they can vouch for a bunch of other certificate authorities, and those certificate authorities can now go and vouch for other certificate authorities, and et cetera, et cetera. And there's this like kind of chain of trust that gets formed. And so the idea there is that when you visit a website and you see the little green lock on your site, essentially what's happening is that your browser is checking the certificate that came with that website. That certificate was probably signed by like some random certificate authority. It doesn't have to be like one of these root level ones. But if you were to go up the chain of trust, you would see that certificate authority at the end of the day was like had, up it like at the root of its chain of trust was like some known root authority. One thing that we've been exploring is kind of taking a similar model with underwriters, is essentially having underwriters kind of co-vouch for each other. So you can imagine there's like a root level underwriter that's like our TransUnion sort of equivalent, and every sort of underwriting prediction that happens at the leaves, like some random underwriter in Arkansas or something like that, has sort of a chain of trust that delegates up to that root underwriter that kind of co-vouches for their underwritten prediction. And so in that sense, you take this notion of starting with a small trusted set of underwriters and then take that and like shard it out. So now you can have many different underwriters and they can all kind of derive their trustworthiness from that small set. So that's one idea that we've been actively exploring.
I can see how that might work pretty well. Say there's a country, and within that country there's regions, and within those regions maybe there's little villages, and there might be a village leader who has a really great reputation and they can strike out on their own and try and be the country's authority, or they can say, I'm very much trusted within this village. Everyone knows me. I walk by so-and-so's house every day. I have a sense of how many goats they have and what's going on. I'm going to personally underwrite these, and it rolls up. Yeah, I definitely can see that playing out.
These are early concepts. Like for the more technical listeners out there, you can probably think of all sorts of technical flaws of this and all sorts of issues. Like, this is very much something that's like a quarter baked idea that we're working on, but it's one of the concepts that we've been playing with that we're pretty excited about. The honest truth is that we're not going to start like throwing our resources into these things until we see how underwriting kind of plays out empirically with the system that we've built so far. Taking more of an experimental, empirical approach than trying to like bequeath the perfect system from day one at the perspective that we have right now.
Sure. Yeah, we could hash out I guess this isn't traditional crypto economics. This is like crypto debt economics or something, but there's a lot of game theory to play out in this field.
It's super interesting that you say it that way, actually, because I was just having a conversation with Jill Carlson, actually, if you know who she is. And what we were discussing is kind of how there's like different standards of security that I'll take a step back. So Jill comes from a background of trading sovereign debt at Goldman Sachs and then eventually later got into like the crypto space. And something we were discussing is that it's like the standard that crypto economists hold to security is usually like that of like cryptographers, right? Where like a cryptographer standard is going to be like this hash function can't be broken even if we had like a computer the size of the moon. That's great. Like that's what you want, right? Like that's what makes like computer security as like stable as it is. But the irony is that like inherently, like when it comes to like debt capital markets, there's no such thing as trustless, right? Because inherently the point is that you're buying risk. Like you're just pricing and buying risk at the end of the day. And so like you kind of have to like take very different standards. The problem you're solving is less so trying to eliminate the risk per se, so much as just like remove information asymmetries as much as possible. And so it's a very different problem set with very different constraints around it than, like say a reputation system in the context of like a crypto economic system.
It seems somewhat analogous to hashing through the game theory related to democratic systems and voting. You assume some people aren't going to vote. You can assume apathy within debt systems. You can assume people are going to default. You can assume that just bad things are going to happen, and that's built into the models. Yeah, it's really interesting.
Not binary in success.
Right. So I guess drilling a little bit deeper into this third chapter about what problems are being solved for whom, I'm really glad that we broke out some of these like first class operators within the system and some of the related issues around identity and trust. Just sort of at a high level, what sort of large problems do you think are being solved for whom? Like I can tell you as a holder of crypto assets, I would love to get a return on my BTC denominated in BTC. I'd love to get a return on my denominated in ETH. So like that strikes me as a lender, that's a problem. As a borrower, that use case is pretty well understood, the reasons why people borrow money. And then there's developers and entrepreneurs who want the ability to solve problems in a kind of a permissionless way. And so I guess that's sort of the third category. And something that strikes me here is that there's a real tax, at least in the United States, to being centralized. And that tax is that once you are centralized, the government can peer into your systems. If you're a relayer, they're not going to knock down your door because you're not holding capital. But the second you're custodying funds, a very different set of standards apply. I'm not thinking about this so much as like people trying to evade regulation, but it does seem like once this plays out in a truly peer-to-peer decentralized fashion, that frees up the innovators to truly innovate and not spend the bulk of their time filling out paperwork and talking to various government bodies.
Yeah. So this is part of like the thorny issue with any sort of protocol that is, as I would call it, like semi-decentralized, in that like it's not like fully end-to-end decentralized in that there are no centralized entities involved, but it's like an open market for centralized entities that where like if one gets shut down, it's really easy to crop up another one. With respect to kind of like the question of regulatory issues, if I've interpreted it correctly, the first thing I'd clarify is that relayers don't custody any funds ever at like any point. They are simply a bulletin board where these like loan requests are actually listed.
Are they on-chain or off-chain books?
They could be both, right? I think like most are going to be off-chain because that's just like way more efficient. But you could theoretically have an on-chain order book that was entirely decentralized. It would just be a lot more expensive. So they're not necessarily custodying any funds per se. With that being said, right, like it's like these are legal murky waters that nobody has answers for yet. You can ask any relayer either in the 0x space or in like the Dharma space, and they're all trying their very hardest to be compliant, but there's just really not enough clear guidance yet around like what legal classification these entities have. But I think it all just boils down, that kind of like goes back to the question that you're asking, which is like, okay, well, sure, the barrier may be lower, but now there's like, you know, all this other crap that you have to deal with in terms of like the legal issues around it. And the response that I would have to that is twofold. First of all, I would argue that it creates dimensions for differentiation on both sides of the spectrum. So whereas like one would think that purely like economic theory, being a relayer should be like a super commoditizable good, right? Like it should basically be like anybody can host one of these servers. And now like, you know, it's the same underlying technology. It's the same service for the most part. So the price should theoretically go down to zero. But it's actually these sort of regulatory friction points are kind of exactly where, in my opinion, the value capture is to be made for different relayers, and that like you can differentiate yourself on either side of that spectrum. The one like very kind of, you know, nefarious side of that is you could choose to be like the Binance of relayers and just like completely brazenly like not care about regulations and list everything under the sun and, you know, enable huge amounts of liquidity in the ecosystem at a much higher regulatory risk. On the other side of the spectrum, though, I would argue that you actually have the ability, for instance, for people to take an entirely regulated approach and cater instead to institutional buyers in the emerging kind of market of the so-called security tokens, right? And that in and of itself is like something that is definitely going to be more expensive and is definitely going to take time and lawyers and all sorts of things. Those expenses that are spent upfront trying to construct a legally compliant relayer are also a differentiator and also a moat. There's an argument to be made that like that is the side of the industry that's going to have all the real liquidity on it. And the idealized version of what we're trying to build, like this could be entirely decentralized and you wouldn't actually need to have like centralized relayer entities. But I think the more realistic kind of stopgap solution that I think still achieves a lot of the same aims is having like, you know, these centralized entities like serving as relayers. And I would argue that even though there are legal complexities around it, that you can actually turn those to your advantage as a differentiator in a sense.
We see that playing out in all kinds of different forms with exchanges, right? You can go the Binance route and kind of lean on jurisdictional arbitrage, or you can go the Coinbase route and decide that you want to be regulated 7 ways to Sunday and that you're going to do everything in a fully compliant way. And there's definitely pros and cons to both paths, but that's absolutely a place for potential differentiation. Is there value from a regulatory perspective in unbundling the underwriting function from the lending function? In other words, are you held to a higher standard if you are both the underwriter and the lender?
That is a question that I don't feel comfortable answering. It's just complex from a legal standpoint, and I don't want to like give bad legal advice.
So if you're considering starting a relayer and you want to explore also being the underwriter, consult your attorney.
I would actually emphasize that much more forcefully. If you're looking to build any sort of business within the Dharma ecosystem, or mind you, as a blockchain entrepreneur at large, make sure you have a lawyer and make sure that you're consulting a good one, because this is the murkiest sort of gray area of the legal space right now that's kind of at the intersection of fintech, which is already kind of like a regulatory mess in and of itself, and cryptocurrency, which is like the wild, wild west badlands. So I'd emphasize like it's important to make sure that you're doing things in a compliant manner.
Okay, that's all for Chapter 3. Let's move to Chapter 4. In Chapter 4, we're going to focus on the top use cases and investment opportunities for tokenized debt. Chapter 4 is of particular importance to me because this podcast is first and foremost for institutional investors, and I'm covering this topic because the dual issues of debt and lending are just too big to ignore and absolutely rife with investment opportunities, many of which we're going to talk about right now. Nadav, let's talk about the top use cases for the Dharma Protocol. It strikes me that you're somewhat of a philanthropist, not to say that you're not a capitalist as well and that there isn't economic gain to be had with your work on the Dharma Protocol, but you could have done a token sale and you haven't. I'm sure there are many businesses that you could create on top of your platform, but you haven't done that yet either. My question to you is this: when you put your capitalist hat on and you see all the opportunity exists within this emerging Dharma ecosystem, where do you see the most opportunity? And if you were an entrepreneur or an investor listening to this podcast, what types of projects would you fund or build? In other words, when you see the range of opportunity that exists and consider an incredible number of potential use cases, which do you find to be the most compelling?
It's funny that you ask this because we're literally about to release a blog post that we've called like the request for like blockchain finance startups, which is a play on, if you've ever followed like Y Combinator, they have the request for startups essentially. And so we have all these ideas for things that we want people to build on Dharma that we think are going to be fantastic businesses. Essentially, like we really want to seed the community with these ideas and see people build them out and build kind of successful businesses. So I can give you a couple of examples of this. So unsurprisingly, they fall into the buckets of like different types of relayers and different types of underwriters, because that's like the first class citizens of Dharma Protocol that basically like we're optimized for right now. So of the former, I'd say that there's a really interesting model for creating basically like a prime brokerage for security tokens. And we discussed this earlier, but right now, there's a lot of people who are buzzing about this notion of security tokens and how huge they're going to be, and like a lot of people that are also skeptical of them. And I honestly can't even give you a yes or no answer of like how the hell it's going to pan out, but like I really don't know. But if you buy into that thesis, which is a very reasonable thesis that basically bringing all of the efficiencies of crypto tokens into securities trading and clearance is going to like totally change the game of how the financial system works, then like any robust financial system like needs prime brokerage services. So it needs somebody that's basically like willing to like give you leverage on your assets in some capacity or let you do things like take short positions, et cetera. And that's like basically, when you distill what that business is, it's basically a relaying business, right? If you think about it, it's essentially just like matching borrowers and lenders in some capacity. Though in the kind of traditional financial system, that capacity is like very custodial, like you're literally getting debt capital from somebody and then lending that out or using that to purchase assets that you're lending out. But in the relayer model, you could basically build a website that does this entirely non-custodially and has the correct like compliance clearances and, you know, broker-dealer licenses, ATS licenses, et cetera, that are necessary in order to facilitate all sorts of debt-related transactions in the world of like security tokens, essentially. So if somebody wants to, for instance, go short on like a CDS that, you know, is insuring some class of like sovereign bonds and it's represented by a token, then, you know, they'll want to like borrow that token. And somebody is going to need to like be able to find the other side of that trade. And that's where that relayer would come in. So that's one business that we're pretty excited about that we'd love to see people build out. I'll give an example from like the underwriter side of things, because I think there's a couple of really interesting niches here. One's a little bit of it sounds silly at first blush, but I actually think this is a really big deal. We refer to it as an appraiser for crypto collectibles. And so what that means is like, you know, I'm sure that people or your listeners are aware of this kind of emerging class of tokens that we refer to as like non-fungible crypto collectibles. So the most notable example that's been in the press is CryptoKitties, but this asset class has grown like just like incredibly rapidly to the point where like I don't know if you're familiar with the website OpenSea, but their marketplace for these different crypto collectibles. This asset class is like less than a year old. CryptoKitties was like a phenomenon in like October, and there's already 700,000 plus different crypto collectibles listed on this website. It's like wild, right? And you have like mainstream brands that are starting to enter the picture, and Steph Curry has a CryptoKitty that is like themed after him and is like co-sponsored by him. And there's all sorts of brands are starting to enter and starting to realize that this is like a really cool way of basically like marketing themselves with like trading cards functionally. And so it's a really interesting emerging asset class. And my personal thesis is that this is going to like grow tremendously over the coming years, especially as it kind of like enters the world of gaming. And many of these assets will be like tremendously valuable. But on the other hand, by nature of them being like non-fungible, they're not going to be super liquid, right? It's harder to take like a CryptoKitty. It's not like when you have like an Ether, like there's a spot price for it that you could always find basically like a buyer for, right? And you could always sell it like pretty much instantaneously. While with like something like a CryptoKitty, like you basically have to put it up for auction. And so essentially, since it is like a asset that can become valuable and also is relatively illiquid, it's actually a great candidate for being used as collateral in a loan. And so it sounds kind of crazy, but I think that there's a real business here to be made where in order to have things like crypto collectibles be used for leverage, for literally for borrowing against them in some capacity, you need to have somebody appraise the value of that asset, right? Like somebody needs to come in and be able to determine like, well, what would the going rate of this CryptoKitty be if it were to be collected on as collateral? And that, in my eyes, is an act of underwriting.
That's super interesting.
Yeah. And so it sounds silly, but I do think that it actually makes a lot of economic sense. And the numbers kind of back it up in terms of the volume that's been going into this niche.
Just thinking about a real world analog, there aren't really deep markets for fine art, for example, or for Van Gogh paintings. But if you put them up as collateral, they do have real value. And the cost of losing those assets is fairly high. So there's motivation for people to service their debts when that is a collateral. So that absolutely makes sense. What about in terms of just super low hanging fruit? Like I imagine if you built a 0x relayer and you want to offer, margin loans, you already understand the model. It's probably a pretty, like, I don't want to say easy because nothing's easy in this space, but it's a logical extension. You understand the model. You understand Solidity and how Ethereum works. Can you extend that business a bit by offering margin loans with Dharma alongside trades on 0x?
I would say that the answer to that is absolutely. And to any of the relayers in the 0x ecosystem that are listening right now, we would love to talk to you.
What about factoring? That was something that we talked about prior to this interview. Is that also seems like low-hanging fruit potentially?
Yeah, so I think factoring is interesting. The biggest thing with factoring is like, can you in some way tokenize the kind of expected cash flows that are going to be coming? Like, can you in some way collateralize those? If it's just a matter of like underwriting, from the underwriter's perspective, like we could imagine underwriters emerging in the Dharma ecosystem for like virtually any type of debt, right? But like the use cases that in my opinion make the most sense are the ones that are like proximate to the crypto industry where people are, like very expectant to receive some sort of like crypto asset or are comfortable with receiving like ETH or DAI or whatever. With respect to factoring,
just for a second, could you explain what factoring is for folks who don't know what that is?
So factoring is kind of like, it's like invoices. It's basically like there is like $100,000 that is en route to me soon, like that is paid out in some sort of invoice and like it's for sure coming to me, but I need money right now to do something. And because of like, I don't know, like some issues with cross-border settlement or something like that, it's going to take a while to get to me. But I need cash right now for buying some more inventory or something like that. So factoring is generally like loans that are backed by those future cash flows that are like essentially like somebody gives me a loan right now so I can buy the inventory that I need. And if I don't pay them back, then they get the cash flows that were coming to me in that invoice. So it's generally considered to be like one of the lowest risk classes of debt. In a super crypto native environment, it's not like super relevant because like inherently like crypto is just like super fast, right? Like it like basically like settles instantly. In a purely crypto environment, it doesn't like map super well. But one particular use case that is at least like adjacent to that, which I think is pretty interesting, is essentially like, are you familiar with OpenBazaar?
I am, yes.
So yeah, so for those who don't know, OpenBazaar is this sort of like decentralized platform for marketplaces that initially were powered entirely by Bitcoin, but now are powered by, like basically like larger variety of assets. And what's kind of cool about, like being a seller in something like OpenBazaar is that you can actually have all of your cash flows that are coming in be on chain. And so you actually, in some sense, have like a pretty empirically measurable notion of creditworthiness because you know what the like seller's public key is, and you can see all the like the funds that have basically come in there from different public keys, and you can see their inventory kind of dwindling over time. And so I think there's a really interesting opportunity for essentially like underwriting inventory loans for sellers on places like OpenBazaar. And more importantly, I think there's actually a world in which you could literally like tokenize the expected future cash flows of a OpenBazaar seller and put them up as collateral. So you can imagine the address that I have that's publicly listed that is supposed to be the one where I receive like all of my payments for different like inventory items that are purchased on my OpenBazaar store is actually like a tokenized asset that if I don't pay back a certain loan that I used to buy my inventory, then that address is seized. And now like all future profits that come to it are basically held as collateral. So there's lots of interesting arrangements you can make.
I just want to riff here with you because like several come to mind. One is if you're a large employer, and so that's an example of recurring payments at scale. If someone can commit to locking down a smart contract address through which they're willing to be paid, maybe in DAI or some kind of stable coin, and you have to wait 30 days before changing that, then a service they could offer is very low interest payday loans against, a forthcoming paycheck. Or if there was a crypto native version of Patreon, if you know what the churn is on that subscription base and you're willing again to be paid through a smart contract, it's not perfect, but if you have enough of a track record, it's very unlikely that your entire supporter base is going to unsubscribe on a given day. So if you have 7% monthly churn, maybe you can borrow up to a third of your expected income or a half of your expected income on a given month and see that paid. Another example is like maybe a Stripe or a crypto version of Stripe that caters to, or like a Recurly that caters to software as a service businesses. Again, if you have 20,000 customers, your monthly churn is 2%. I think it would be pretty low risk to offer some portion of expected annual income to that business at any given time, again, funneled through the smart contract. It does seem like this is rife with opportunities, but it does require a crypto native infrastructure to really work.
Yes, but also like you actually brought this example up yourself, which I think is super notable, is that like it doesn't necessarily have to be a cash flow that is perfectly tokenizable or like perfectly held as like collateral, because you mentioned Stripe, for instance, which is like a payment processor. Like they have a trove of data about what the recurring revenue of a whole set of internet businesses looks like. I'm not saying this is like likely to happen in the near future, but a Stripe would be an excellent candidate for an underwriter in Dharma Protocol insofar as like they have like this perfect image of what's going on there. Yeah, sure, they could go ahead and like pull a Square and like try to spin up like Stripe Capital and like start offering loans, but creating like a full lending business is like a really onerous activity that requires like a really upfront investment. I would argue that with something like Dharma, like you can immediately kind of apply the data science knowledge that they have in-house already, probably, just to map out their own personal profitability and use that to underwrite loans.
It's a great way to monetize your data without putting capital at risk or confusing your investors or your CFO, who all of a sudden are going to see new line items on the P&L and wonder what's going on there, especially if you're like a VC-backed company and you're already borrowing money in the first place. To enter in a completely different business is kind of absurd. No, I absolutely see it. Or for a company like Patreon, essentially any recurring payment business, and that includes employers where they have a really good sense of churn over time, I think can provide fantastic data that would allow them to be great underwriters. I like that a lot.
It's so funny that you mentioned the employer portion of it, because that's actually something that we are dealing with right now. Like literally as of yesterday, like we have a certain employee that's like, they're looking for an advance on a certain part of their salary because, they're having a certain issue that they have to deal with. It's not a big deal, but like basically like they're dealing with this issue right now, and we're literally like trying to arrange this exact thing right now. We're like, well, we could literally use the tech that we've been building for the past year and a half to do this.
We've now concluded Chapter 4 on use cases for Dharma and programmable tokenized debt. Let's dive into Chapter 5, where we discuss Dharma as a corporate entity, how it works, where the company is located, and how they make money. Nadav, can you tell us just a little bit about where you're based? Are you hiring globally? What kind of legal entity are you? Have you done a token sale or not? Also, can you tell us a little bit about your business operations? Are you a decentralized DAO? How do you operate and function? All that stuff.
this is probably going to be the least interesting portion of the podcast. We are a vanilla Delaware C Corp. We are a for-profit company. We do intend to turn a profit one day off of the infrastructure that we've built, though it is right now entirely free and open source to use, and that will never not be the case. We did not opt to do a token sale because we felt that though tokens are a super promising model, we felt that like it wasn't super lucidly clear how and when they actually capture value. And we didn't think it would be honest to kind of sell basically like tokens to investors that we didn't even really necessarily have a good explanation of like whether they would act as a good proxy for the value we're building. As for kind of more information about the company, we are based out of San Francisco. Currently, we're a team of 6, but we're rapidly growing and we are very much hiring right now. We're looking for engineers, obviously, but also for marketing people. We're looking for product people. We're looking for designers. We're looking for people who can engage with developers well. And so if you fit into any of those categories, we'd love to hear from you. We are primarily hiring locally. Like we're looking for people who either are in the San Francisco Bay Area or are willing to move out here. But we are also open to the possibility of remote hires for particularly exceptional people. So if any of the things that I just said in the past 2 minutes or 2 hours sounded appealing to you, then, we'd love to hear from you.
How are you funded? I know you went through Y Combinator, but that's certainly not enough to fund 6 people in a San Francisco office. Have you done a Series A?
We have not yet done a Series A, but we raised the seed round approximately almost a year ago at this point now.
And if folks want to contact you, either an entrepreneur who's interested in building an app and would like perhaps some guidance, or a potential employee who'd like to apply for a position, what's the best way to get a hold of Dharma or you specifically about those things if you'd rather that be the case?
There's a couple of ways you can find me. First of all, my email is nadav@dharma.io. I am super receptive to cold emails, though I can't promise I'll answer quickly. It's pretty easy to reach us on our Telegram too. So if you kind of go to our website and navigate your way to the Telegram channel, you'll be able to chat with us. And then finally, if you're kind of like more explicitly interested in joining the team in some capacity, we have a careers page that you can find on our website and apply through there.
So we've now concluded part 2 of our deep dive on the Dharma protocol and tokenized programmable debt. I hope you've enjoyed this conversation as much as I have. If you've gotten something from it, I hope you share it with others to the degree that you found it useful. Just to close this out, I want to remind you that there's been a lot of talk in the blockchain space about tokenized stores of value like cash, as well as tokenized securities and commodities. But the topic of tokenized debt that we cover here has received such little coverage despite debt markets being larger than stock markets and money supplies, and I just think it needs a lot more attention. I hope this deep dive will contribute to an uptick in dialogue and actual work on tokenized debt markets and work on top of the Dharma protocol. But most of all, I hope you personally found this content to be helpful. So let's sign out now. We're done. See you next week. That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.